What a jingle. What a time. What a time to be alive. Great to be here, everyone. Thanks for tuning in. I'm thankful to be here today. Market's been rallying a ton. I'm excited with my producer, Diggs, behind the scenes. Shout out to Diggs. I'm Rob Tatro, for those of you who don't know me, from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management. I'm live 8 p.m. Central Time, 9 p.m. Eastern. For the first time in a while that I do this in the evening. I think it's going to be fun. We're going to talk about the market. I'm here to answer any questions you guys might have. Sectors, anything that's moved a ton lately. You got questions on your mind. I got some charts up. I got some sectors up. I got some opinions, valuations. I'm ready to talk shop. Maybe tell you a bit about my life recently. While you guys are here, I've been growing a greasy mustache. Not sure how I feel about this mustache. I'm doing it for cancer research. I'm raising money for two charities. Prostate Cancer Canada, which is now a part of Canadian Cancer Society. And I'm also doing it for the Canadian CMV Foundation, two health charities that I'm trying to raise awareness for. Trust me, I don't want to look this ugly naturally. Anyone watching out there, if you're watching, give me a quick shout out. I want to make sure this is working. Post a comment if you're watching on YouTube or on Facebook, on wherever you're watching, on LinkedIn. We got our first question. Wow, that didn't take long. First question already coming in from Beryl. Let's show this question here. Do you think now is the time to invest or should I wait? All right, so $1 million question. Here's how I feel generally about market timing risk. All right, good to see Rob Sarrazin, Nicole Ditko. Thanks, guys, for tuning in. Pretty excited. So the key with market timing, basically what you're saying is, should I invest now or should I wait? That means you have cash on the sideline. Now, this cash, first of all, I would ask you, what is it for, Burrell? Is it long-term investing? Is it short-term investing? Are you using that cash to invest, next week or tomorrow or a month, or you're using a down payment on a house? If you are, I would say now's a good time to invest, but think about your asset allocation. Go, I'd say, more defensive. Think of some fixed income opportunities, some private debt. Think of getting a lower yield on your investment income. However, Burrell, if this is long-term investments and you're thinking that you want to place this money in the market for the long term, I would tell you it's always a good time to invest. Good to see you, Corey. Now, the question is, how much of the money do you invest? You always want to be invested. You know why you always want to be invested? Because the market consistently generates returns in the double digits if you're properly invested and if you have good asset allocation. We've seen it 10 years, 5 years, 20 years, 50 years, 100 years. The market doesn't disappoint, right? There might be a period in there where it doesn't go well. There might be a year or two or three or five. But if this is long-term money for you, Burrell, you want to be invested. You want to be invested long-term, and you want to continue to put that money to work. Now, if it's a portion, if you're worried about how high the Dow is right now, if you're worried about how high the S&P 500 is, one thing we recommend is legging in. So if you just got this money, if you inherited, I don't know, 100 grand or 500 grand or $1 million or 5 grand, and you're putting this into the market and you just got that money and you're sitting on it. So what I would tell you is put a portion in. Consider legging in. Consider legging in, which would mean a portion now, a portion later, and a portion at a future period of time. What I would suggest too is to make sure that you have a predetermined plan in place. So it's not going to be when I feel right, because you know what? You're probably never going to feel right to invest. So I think the key right now is that you want to make sure you are invested. You don't want to miss this rally. I believe our call at Canaccord Genuity is for a long-term cyclical bull market. We believe there's another kind of a 4-year. We believe in the 4-year cycle. There's probably another 4-year cycle here. We're probably into the, leg 2-ish or something like that of that cycle. Tons of stimulus. There is going to be corporate profits, and long-term, you want to be invested. Now, one thing I know for a fact is I do not know what will happen with the stock market tomorrow, and I don't know what will happen next week, and I don't know what will happen next month. One thing I know for a fact is that I don't know what will happen short-term. However, Burrell, if your money is long-term, you want to have a portion of that in the market now. You want to have a portion in a month or 2 or 3. And if you're worried about volatility, by all means, go half or go a quarter, leg it in chunks. We got a question here from Marc-André Habeck. Hey, Rob, what would be the best course of action when you have matching RRSPs for your company? All right, great question. Marc-André, the key here is, first of all, you want to max that matching. So if they're willing to match 4 or 6, usually it's 2, 4, or 6%, somewhere in there, you want to max that matching. Now, especially if your cash flow can allow it. So if your cash flow allows a max contribution, you just want to max it. You want to contribute as much as you can. Now, a lot of these times, these pensions, these kind of pre-managed pensions might be managed by an insurance company or one of these large pension style brokerage firms. You might feel like you don't have a choice in the investment strategy, Marc-André, but I would tell you that you probably do. You could probably go online, and if you're young and you want max growth, put that into a max growth, put that into US and global equities. If you're careful, you're cautious, you're defensive, put that into a more conservative approach. If you're just a traditional investor and you don't know what your risk tolerance is, don't hesitate to go with a balanced approach. All right. So, and if you're not sure about any of these, by all means, reach out to us, www.speaktorob.com. We'd be happy to chat about that. But generally, Marc-André, what you want to do is max the contribution. In fact, some of these plans will allow you to do a TFSA contribution, an additional RSP contribution. You should definitely look into that. Talk to your HR. If you have no other option for investing, if you don't have 500 grand, if you don't have a large investment account with an investment brokerage firm, that might be an option to top up your contribution by $1,000 a month or every 2 months or something like that. Or maybe it's $100 a month. Whatever it is, it's probably a great way to start your investing. Question here from JT Online. JT Online, hey, Rob, this is coming from YouTube. Hey, by the way, if you're watching on YouTube, take a sec to subscribe to our videos. If you're watching on Facebook or LinkedIn or Instagram or Twitter or wherever the heck you're watching, take a sec, click the button, like or share or whatever the kids are calling it nowadays. Subscribe, I guess. Let us know. Send us some love. JT Online. All right, I'm going to show this question. Hi, at Rob Tatro. Can we trade lira through our brokerage account? Of course you can. Absolutely you can, JT. So the way you would do this now, I've never done it through a discount brokerage account. I imagine it's a little more complicated because the paperwork will be a bit of a hassle. But here at Canaccord, we open liras for clients all the time. So clients have a locked-in retirement account. That is typically as a result of a pension. So, you retire, you get I shouldn't say you retire. You leave a place of employment. Maybe you get a severance package. Maybe you get, I don't know, whatever you get. But you get that into what's called a locked-in retirement account. So you're leaving the place of work. You have put money, like Marc-André did. You've put money into this investment account. Now you get to take this money out. So you're typically going to have 2 options when departing a company. One option is you withdraw the funds and you take them as a locked-in retirement account. So that is your money. You own it. You take ownership of it. You decide who your beneficiaries are. Those are your dollars. You decide the investment strategy and you take that money to any investment house that you choose, Canaccord or a discount brokerage. The other option is you take the future pension. So they'll typically give you, at 65, you get this much, survivor's pension, you get this much. That is a future option. I can tell you back when I started in this business, the 2 options were a lot more even. Some people would take the lira, some people would take the pension. But I can tell you that as interest rates have moved down in the last while, most of the times when I see pension analysis, the lira option for most people is dramatically the better option. So think about that when you're doing your lira. I don't know how the paperwork exactly will work because we have staff here that takes care of that and our clients don't have to worry about the paperwork, but you can absolutely unequivocally open a lira at any financial institution in the country. The question is, are they willing to do it for you? All right, we got a question from Ian here. Ian Humphreys, thank you for the question. Ian, thoughts on American airline stocks? I believe he's talking about the sector as a whole. Assuming a widespread administration of a vaccine in 2021, do you foresee revenue returning to pre-COVID volume? What a loaded question, Ian, but I do love that question. Thank you for bringing it. Love the heat that you're bringing. So let's start first of all with what I think will happen with respect to flying. Okay, so with respect to flying, here's a guy that flew 39 times last year in 2019 and has flown 0 times since March 10th or something like that. So I've realized in my business that going for the one-day meeting to New York or going for the one-day meeting to Toronto or Calgary or Halifax, I don't think it's necessary. I think business is changing. I don't know if it's changing forever, but I do think that right now business has changed to the point where the one-day trips, the in and out meetings, I think they're going to stop. So that's a decent chunk of travel, airline travel. I think it's 40% or something like that. So I don't know how much of that is going to stop, but some of it will stop. So leaving that portion aside, I believe your question, Ian, I'm just going to pull it up again, is, do you foresee return to revenue in pre-COVID volume? So I guess, obviously, if the answer to that is no, not everyone's going to fly the same amount once we have a vaccine. But that being said, there's going to be consistent growth, as population grows. The airlines are going to have to figure things out. They're either going to have to charge more for a seat. They're going to have to cut some flights. They're going to have to figure something out. I'm a firm believer that we will have less airline miles in 2022, let's call it, than in 2019, just as a result of COVID, because of the remote factor, the fact that people are discovering and they're realizing that they don't necessarily need to get into a plane to close business or to go see their girlfriends. I don't know. But I think it's a change that will happen. Now, maybe to push a little further on your question, Ian, you might be asking me, should I buy airline stocks right now? Well, here's the thing. The market is already anticipating at some level. So first of all, don't take this as a piece of opinion. This is just me. I don't know your personal situation, Ian, and don't take this as personal advice. But airlines, here's the thing. By the time you want to get in, by the time you're thinking, oh, I want to get in, the market is already anticipating. The market is already pricing in the likelihood that people are going to get back to normal. So the reason airline stocks have rallied so much in the last month is not because people are flying today, right? It's because people are flying, or the market expects people to be flying in 6 months or a year or 2 years, right? So I think you have to just remember that the market is pricing everything in. So if you believe that you're going to buy airline stocks and outperform the market, you must believe, Ian, that either the market is underestimating the likelihood of flyers coming back, or 2, underestimating the potential future profits for these airlines, or that you know better than the market. And I would just say this, the market is incredibly humbling. So just make sure you've always got your humble hat on. And just make sure you're always prepared to be humbled by the market, as my dad would say, because it punches. The market punches like Muhammad Ali or like Mike Tyson, and it teaches you a lesson every once in a while. And it's important to remember that we do not know more than the market, right? Dan Brindley, question here. Let me pull this up. It's a question about day traders. So the corporation market and banks want long-term stable investment. Day traders, he calls them scalpers, are in and out for quick profits. Swing trades are short-term wave riders. Chart analysis most accurate. Swing trades are short-term wave riders. Are short-term wave riders most accurate? Okay, so here's the thing with respect to day traders. I don't know if I'm going to for sure answer your question, but I've seen so many people. Oh, it's longer yet. Oh, algorithms trading does most trading now, but manipulation can be done with larger investors and started trading time and correct. I don't know if you're a conspiracy theorist or what, Dan, but I'm just going to reread your question very, very briefly here. Trading does most trading now, but manipulations can be done. Large investors, insider trading, time and correct. Okay, so I'm not going to get into the whether or not you can manipulate the market, because I think that's a question for another day. Let's talk about swing traders and day traders, okay? So day traders, what do? They try to take advantage of the fact that they can have orders on both sides of the thing, and they're just going to trade the volatility of a stock on a day-to-day basis. They'll say, all right, Royal, any bank stock, insert bank stock here moves generally 0.5% per day or 1% per day. We're going to put a buy at the low and a sell at the high, and we're going to make money off that spread, right? So multiple trades throughout a day, and they're just going to chip away at the spread. So that works well. That works well for 99% of the time. But, I've been in this business long enough. And if my dad were here, he's probably watching at home in Marchand, Manitoba with a glass of wine. And he's probably thinking of all the day traders he's seen in his life effectively get wiped out, because you don't need to be on the wrong side of 50 trades to be wrong when you're day trading. You need to be on the wrong side of one trade, right? So you're day trading. And then when it doesn't hit the top, like in March, like we saw in the oil price, people could get wiped out. So I don't know if I answered your question, Dan. I think you're asking about algorithmic trading, and I think you might be asking about the volume that this brings to the market. Feel free to ask again if I didn't answer your question. I'd be happy to hear you guys out. Question here from Sean. Sean, let's put your question up. How will Canada's ballooning debt impact the economy and the investments? Whew. Okay, so this is a long-term play. So the first thing we need to know is Canada has effectively said they're going to write a blank check, and they're going to cut, they're going to make sure that everyone is taken care of throughout this COVID pandemic. Now, I'm paraphrasing and I'm exaggerating, because I know a lot of people are not taken care of, and I know there's a lot of uncertainty in a lot of people's lives right now. I'm paraphrasing, but generally the government has said we want to spend a lot of money to make sure that Canadians, can recover from this. So one, that's effectively unlimited stimulus, fiscal stimulus, and the expansion of the balance sheet. So two things are happening there. Fiscal stimulus is money directly in our pockets. So you get a $600 check every 2 weeks for CERB, or an $800 check for CERB. And the other one is the expansion of the balance sheet, which is the government going out and buying corporate debt, or issuing debt, or buying debt. So the idea with that is it's generating liquidity in the market. Both of those are expensive. Both of those, someone's got to pay for that at some point. So your question is quite good, Sean. The thing the fear is definitely there, and there is going to be a day of reckoning for this. However, I will say this: back in the 80s, 70s, 80s, 90s, when we were issuing a ton of debt, you would look at your balance sheet and you would see debt at 7%, cost of borrowing 7%, cost of borrowing 8%. Our cost of borrowing right now in Canada, we can issue 30-year debt at less than 1%, or 10-year debt, or 5-year debt. So it's a dramatically less of an impact. Think of it if you personally, think of your own balance sheet out there. So, whoever asked the question, I forget, but you're borrowing $1 million, and you know what? It's a tough time. So you need to borrow $1 million, and it's going to be for 10, 15, 20, 30 years, because that might be how long it takes for the government to get out of this. So if interest rates were at 8%, that would not be the greatest, obviously, because that's an expensive annual cost of carry on that debt, right? You got to pay $80,000 a year to carry that $1 million of debt. Where are you going to come up with that 80 grand, right? If you can't come up with that 80 grand, you're wiped out. You can't carry your debt. Now, the government of Canada, they're issuing record debt right now at record low interest rates. So yes, it's not good. I know it's not good expanding the balance sheet like this, but just to put things in perspective, you can issue 5 times the debt at 1%, then you could issue at 5% and have the same cost of carrying on your cost of interest rate cost, or carrying cost on your debt. So it's not great that we're issuing it, but goodness, if you're ever going to issue debt as a country, you want to issue it at less than 1% at all-time low interest rates. And yes, I know you got to pay the piper at some point, but it also effectively guarantees, if you're a believer out there that the government doesn't want us to go bankrupt, it also effectively guarantees that they're likely not to raise interest rates for a very long time. So if you're out there and you're sitting on cash and you're waiting for interest rates to rise before investing, you're going to wait a very long time, my friend, because I don't think we're going to see rising interest rates for a long time in Canada. My dad's been saying this. I remember when I started in the business, 11, 12 years ago, whatever it was, they used to say back then, interest rates are going up. Interest rates are going up. They don't have a choice. They have to go up. They're so low. They're at 5%. They're at 4%. Then they went to 3%. People were saying the same thing. They went to 2%. Interest rates have to go up. They have to go up. Now we're at effectively 0 interest rates. And I think now people are realizing, you know what? Maybe they don't have to go up. So the ballooning debt will have long-term impact, Sean. I'm not an economist, but I do think relative to the stock market, the market is clearly not concerned about it because of the fact that stimulus is more important for corporate profits than the long-term impact of having trillion-dollar balance sheet. Hopefully that made sense for you. Pull up another question here. Nicole, I'm a conservative investor and my husband is much more aggressive than I am. Would you customize our investments accordingly? Nicole, that's a great question. I think this is important. So the question I would ask you, Nicole, and feel free to chime in. I'd love to hear what your thoughts are on this. I would ask you, how often do you check your performance and your returns? Because at the end of the day, let's break it down. Why are some people more conservative in their investments than others? Is it because they want less return? No, right? If I were to ask you, do you want 5% or do you want 10% annually in your returns? Every single one of you would say, I want 10%, obviously. But if I were to ask you, do you want an investment that might drop 30 or 40%, or do you want the one that might only drop 10%? That's where we get into risk tolerance and asset protection. So the reason that people are more defensive is not because they want less returns, it's because they want less volatility. So volatility is the day-to-day, week-to-week, month-to-month movement in the price of your portfolio or your asset. So what I would ask you, Nicole, is, are you checking your portfolio daily, weekly, monthly? Is it something that's burning you inside to see losses, paper losses, or reduction in value in your statement? Is it something that you're losing sleep about? Is it something that you're making bad decisions on as a result of that? Now, if any of those are happening, you should not be invested in 100% equity. Now, if you're the type of person who doesn't watch your investments, and you mentioned that your husband's more aggressive, maybe he's the one that that is watching the portfolio on a day-to-day, week-to-week, month-to-month basis. So if that's the case and you're actually not watching it, I would say it's not a terrible, terrible idea for you to have a similar asset allocation. But if you don't, right, if you watch your portfolio, you're losing sleep, you can't handle it, you're thinking of selling all your stocks, you're thinking of calling your advisor, then you need less risk in your portfolio. You need less volatility. And that would mean that you should have a more conservative profile than your husband. Your husband, he can do whatever he wants. He's the one now, as long as you're not checking his statement and losing sleep over his statement, right? Because you don't want that either. The key with risk tolerance, everyone who's listening out there, the key with risk tolerance is basically you want to take as much volatility in your portfolio as you can without impacting your life and the decisions you make about your wealth. Because I've sat in this chair and I've had a lot of phone calls in my life from investors that want to make rash, irrational decisions at the absolute wrong time. Unfortunately, retail investors generally, Americans, Australians, everyone on the planet, there's an innate issue with us making decisions when it comes to buying and selling assets. We tend to be greedy when others are greedy, and we tend to be fearful when others are fearful. So what happens is when the market is falling and the Dow has dropped 40%, you don't want to buy. You want to be fearful like everyone else. And the reason the Dow is down 40% is that everyone is selling, right? There are more sellers than buyers. If there are more sellers than buyers, we have a falling market. If we have more buyers than sellers, we have an upward market, right? So typically, retail investors are the worst at making these decisions, the worst. So I know because I sit here at my desk and the phone rings and it's people who want to sell their investments at the absolute worst time, my clients. Or the opposite happens as well. People want to load up on stocks in a euphoric kind of, they're euphoric, I think is the right word, in a euphoric manner. They want to load up on sectors or on stocks that have already run up a ton, or sectors, stocks, or even markets as a whole, and they're just not able to make that decision. So what our job is to do the opposite of that, is to be fearful when others are greedy, and greedy when others are fearful. Fearful. I'm going to take a sip of water here. Anyone working out at home? Anyone doing, what are you guys doing for workouts these days through the pandemic? As I pause and wait and nobody answers because it's just me and a microphone here. All right, there's a question here. I'm wondering why the market rallied so much here in November. Jim from Edmonton. Before I get to Jim, I'll tell you what I've been doing, and please let me know what you've been doing. I bought one of these bikes and I put it in my basement. I bought one of these bikes. So Mox is doing HIIT workouts and dances. Mox is a dancer. Those of you who don't know Mox, he's one of our producers here on the show. He does workouts and dances. I ride the bike. I've been riding this Echelon thing. I've been doing it every morning, half an hour, 45 minutes. It's great. I get my heart going. I can't play hockey. I can't play golf. I can't play tennis. I can't play sports. I'm a big sports guy. So I've been doing the workout. Run, bike. I'd love to hear what else you're doing. Tough to run outside in Winnipeg in the winter when it's minus 40. But I digress. Let's get that question up again, producer Diego, if we can, from Jim. The question was, Rodney Taylor. Okay, good. Another Edmonton listener. I'm wondering why the market rallied so much here in November. All right. So I believe it's on three things. First, it's clarity in the US election. So I'm apolitical. I'm not going to get into politics. I'm not going to tell you what my belief is. I don't really care. I couldn't care less. But I'm going to tell you that the market is anticipating clear, distinct rule of law and transition that is going to happen, and that is good for the market. Also, historically, it's a good fit to have a Democratic president, Republican Senate. Usually the Democrats are going to come out with spending. The Senate is going to kind of rein them in, the Republican Senate. It's typically very good for markets. And in fact, first years of markets where we have a Republican Senate, Democratic president, has historically been quite good for the markets. So that's one, stability in the US election. Two, no doubt about it, it's fiscal stimulus, blank checks being written by every country across the entire planet as to let's spend. That's one big thing. Now, they haven't figured out the US portion yet, the 3 trillion, 5 trillion, whatever it's going to be, but there's going to be a lot of money that's going to be spent. And three, I feel like I'm a school teacher here. Can anyone guess what the third might be? The third, in my opinion, is a incredibly strong string of corporate profits. We've had the best quarter effectively ever in terms of corporate earnings. We've had an earnings beat factor of approximately 85 or 86%, something like that. So 85 to 86% of companies are beating the corporate earnings. So that's an incredible beat factor, something we've never seen. So the skeptic would say, Rob, is that because we've had too low expectations for the earnings? And the optimist would say, wow, that means we're way outperforming. Clearly, the market, with its reaction here in the month of November, which has been one of the best months, like for sure one of the top best months. I'd say, I don't know, I should probably look at this, but it's got to be one of the top 100 months ever. And the best month of the year here. It's been, well, maybe April, I don't know. But regardless, the market is telling you that the market loves these corporate earnings, loves them. Tech came out, they crushed their earnings. Financials came out, they really did well. And all of the micro cap stuff is really performing well. So as a result, you got three things. You got earnings, you got stability in the election, and you got fiscal stimulus up the wazoo. There you go. Three reasons why we're having such a good month. Jim from Edmonton. Diggs, could you queue up another question for me there? In the meantime, see some shout outs there to Rodney Taylor from Edmonton. Thank you for tuning in, Rodney. I must say, not everyone So I can't pull off the mustache. I've been doing it for charity research. Anyone else doing a Movember out there? If you're doing a Movember, please let me know. Please post in the comments. Let me know what charity you're supporting. For me, I'm doing 2 charities. Cancer, what is it? Prostate Cancer Society. I got to know this. And the Canadian CMV Foundation. Diego, you got a question for me there? I saw. Okay. How have corporate earnings been this quarter? Okay, I kind of just went through this with Todd from Regina. But Todd, I'm going to go through it again briefly. But Diego, in the meantime, you can lock me up another one. The key with respect to earnings, I just mentioned it. They've been unbelievable. So tech has, I don't know if you guys recall, about a month ago, Google released their earnings. They beat their earnings. Google, Amazon, Facebook, Apple, Netflix, they all released their earnings within about 2 days. And like these markets didn't appreciate at all. They were like, meh, another day at the office. You know, we just, you know, you made 20% more than you thought they would. So my lesson here with respect to corporate earnings would be, for anyone who's listening, is be very, very careful of a phrase that they call earnings expectations. Earnings expectations, because corporate earnings, they're the ones putting out their guidance for the year. So if I'm CEO of Google or Amazon or whatever it may be, I put out my guidance for earnings in the next year. Do you think I'm going to overshoot my expectations, or do you think I'm going to come in a little conservative, under promise and over deliver? Most of the time they come in under promise, over deliver. Then you got these analysts at all these firms, Morgan Stanley, you know, all the Canadian firms. We've all got analysts and researchers, and we put out our own analysis, our own earnings expectations. And lo and behold, they often beat that. So typically the beat factor is about 60, 65%. But in this case, what we've seen is something more like 80, 85%. So what is the Dow? All right, Craig, sorry. Sometimes I talk a lot and I forget that I got to break things down a little bit. So the Dow, those of you who don't know, it's an index that represents stocks, large cap industrial stocks in the US, large cap stocks in the US, started by 2 financial reporters back in, I don't know, 1880 or 1890, something like that. Does someone want to correct me? Feel free to correct me if I'm wrong. I'm going to guess 1893. And there was a Mr. Dow and a Mr. Jones, and they said, how do we report every single day that the markets are up or the markets are down? How do we do this, right? Because I mean, if I'm a financial reporter and I have to tell you as viewers or as readers in a print, if the markets are up or if the markets are down, I want to be able to tell you in one sentence, markets did good, markets did bad. So they said, we need an index. So these 2 guys, Mr. Dow and Mr. Jones, they went out and they put 12 stocks or 10 stocks. I want to say 12 stocks. It was like American tobacco and like American steel and like railroads. And they put them all in there and they assigned a value to them, the market weight of those, the market value of those securities at the time. And they started at 40 points in the 1880s or 1890s. So that means now we're at 30,000, right? So Derek's chiming in. He says it's 1885. He says it's 1885. Okay, thank you, Derek. I appreciate your help there, Derek. 1885, I was close. I said 1880s, 1890s, 40 points. And now today the Dow's at 30,000, which means if you put $1 in 1885, first calculated May 26, 1896. Oh, nice. Diego, producer Diego on the back. Am I right? Was it 40? I think it was 40, right? $40, 40 they started it at. So now we're at 30,000. So if you've put $1 back then, you've made just about 1,000 times your money in 100 years. 1,000 times your money. That's fantastic. Another question here from Brent. I'm going to put it up. What industries would you look at investing in now? With tech being valued so high compared to pre-pandemic levels, I'm nervous about placing money in tech. Would REITs such as Coleman or Morguard be good? Concerns over holdings with malls. So I'm going to tell you right now, I'm not going to talk about individual securities on here. I just want to make sure my compliance is always happy and pleased. And I'd have to run disclaimers for every single company. We don't want that. So let's talk big picture tech. So I don't think you can have a portfolio right now in 2020 in November 2020 without having some allocation to tech. You need to have some tech exposure, Brent. So I don't know what percent you currently have. The S&P has, 25 to 30%. If you believe in NASDAQ, obviously it's significantly higher, but you need to have some tech. You can't not have tech in your portfolio. I understand it's overvalued, but hey, they've been saying that Netflix has been overvalued for 10 years. Amazon's been overvalued for 10 years. So is Google, so is Shopify, so is all these companies. So these companies are changing the world. They're changing the market. They're disruptors. They're complete disruptors. So I don't think you could possibly have a portfolio nowadays where you don't have them. I don't know if I'd be overweight necessarily, but you definitely need to be market weight tech. So if you have no tech in your portfolio whatsoever, and you've kind of avoided it for all these years because maybe your advisor was a little older and he or she had Canadian banks and Canadian pref shares and Canadian telecommunication companies and Canadian financials and Canadian oil and gas stocks. Well, first of all, you've probably been hammered in the markets the last 5 years. It's probably not gone well for you. And second of all, you've missed out on all that gain, and you've always thought it was never the time to rotate. So to answer your question, I'm nervous about playing money in tech. Would REITs such as Cominar and Morguard be good? So let's just look at REITs generally. We made a bit of a rotation into REITs. Publicly traded REITs were trading at dramatic discounts over the last while here. Now they've somewhat rallied back because people are now realizing that real estate is still going to have value. Regardless what happens, a few people are not paying rents. Depending on what sectors in the real estate market you own, you're going to be okay. Now, I get that there's malls that are going to have to figure their stuff out. I'm a big believer in Amazon. Those of you that have followed me on BNN, I'm not supposed to talk about stocks. So forget about Amazon. I never mentioned that. I did not mention Amazon as being a potential stock favorite for me. Did not mention that. But if you wanted to look at owning malls right now, no one's doing that, right? No one's buying that. So the contrarian investor would likely suggest to you that that's a sector you could consider, whereby the defensive investor would tell you, I ain't touching that with a 10-foot pole. So most of the times when we see these types of corrections, there typically is a reversion to the mean. So I would suggest if you don't own any REITs, you should own a portion of them. You should own either private or publicly traded REITs. They're trading at such a big discount. And, if you believe the yield is safe, so depending on the REIT, if you believe the yield is safe, so for that, I would follow the earnings calls. I would talk, or hopefully you have a portfolio manager, Brent, that could do this for you. And I would follow the earnings call. And if you believe the yield is safe, so look at their payout ratio, look at how much they're paying relative to their AFFO, their adjusted funds from operation. Anything less than 80 or 80%, you'll be fine. And the yield is probably not likely to get cut. That's going to be a good gain because you get paid while you wait, right? You wait for the REITs to come back and you get paid in the meantime. Now, again, I'm not personally, I don't know what's going to happen with malls and I'm a little worried about it, but there's a whole bunch of other REITs that are bound to bounce back and to start doing something. Okay, give me a shout out, guys. If you've taken a flyer on a stock here over the last couple months, if you've taken a flyer on a penny stock, or maybe it's not a penny stock, maybe it's a mining stock or an oil and gas stock, or maybe it's a tech company. Tell me your favorite stock that you've picked over the last while. The great thing about this is you don't have to tell me about all the loser stocks that you picked in your portfolio. You can just pick the winners. Do you see a time here? I'm going to pull up another question here from Mac. Do you see a time that the Canadian currency will close in on American currency? So my call and our call at Canaccord on currency is in fact the opposite, Mac. We believe we're going to be in a prolonged period where the Canadian currency will depreciate to a level in the 68 to 70 range, or low 70s for sure. Now, do not take that as advice. We're not trying to tell you what to do with your currency by any stretch. I don't know you, Mac, and I don't know what your portfolio looks like, and I don't know what your currency looks like. But I could tell you that our call is depreciating value of the Canadian currency. Why? Couple reasons. First of all, we have a fiscal deficit. All right. So significant fiscal deficit. Second of all, trade deficit, significant trade deficit. When those two things happen, historically, the Canadian dollar has depreciated. Finally, we're a commodity. Well, not finally. 3, we are a commodity-based economy. So commodity-based economy means that we need to sell oil, we need to sell lumber, we need to sell water and mining and minerals and material. And the cleaning lady just walks in. No, we're good. Thank you. Yeah, thank you. Mining, minerals, commodities. So we need all that stuff. So in order to get more buyers, right? So how does it work with prices of Canadian dollars? The way the Canadian dollar worked, think of it as a stock, basically. If you have more buyers than sellers of that currency, it appreciates. If you have more sellers, you depreciate, right? So what is the most likely thing to be bought in Canadian dollars? It's our commodities, right? So grain, lumber, oil, minerals, all of that. So if you have that and you have an appreciation of that, it's going to do well. Now, not all of those have done well lately, especially oil and gas. They've struggled. So 3 reasons. 1, fiscal deficit. 2, trade deficit. 3, weak commodities and commodity prices in Canada. And 4, not much global desire to invest in the Canadian economy and Canadian corporations because of high tax rates and I'd say, likely unfavorable attraction to businesses, corporations in Canada. Boy, that's a long answer. That was a pretty good answer too. I pumped my own tires there. So 4 reasons why we think we're going to go the other way. Again, we don't know what'll happen short term, but that's our call. In fact, we've been converting Canadian to USD here at this price because we think it's a really good number to convert Canadian to USD. So if you're a client of ours, you might have a Canadian, you might have a US dollar account, you might have Canadian US dollar RRSP. So if you have both of those, you may have seen some conversions from Canadian to US dollar. Great question, Mac, on the currency. Keep them coming, guys. I'm feeling it. I'm rocking it. This is good. I'm not TikTok Johnny Mox, but it's been good. Still haven't seen anyone put in their favorite speculative stock. I thought Jeff Dean or Derek might give me 1 or 2 there that they've bought recently. Question from Dan. Canadian banks are good. U.S. energy finally recovering, anticipating problem. Energy seem to run cycle season. Yeah, I think it's more of a comment from Dan. I think the comment that I think you're making here, and I think I'll agree with you, is Canadian banks were good. U.S. energy finally recovering, anticipating profitable winter season. Energy seems to run in cycles seasonally. Yeah. Oh, if my dad were here right now, he'd talk to you guys about energy cycles. He saw 70s, 80s, 90s, 2000s. The 10s. It's been, these cycles are painful for energy. And if you're in Alberta, I do feel your pain when you saw oil and gas get hammered in March, April, when we saw negative prices on oil and gas. If you can imagine such a thing where you had to pay someone for them to take possession of a barrel of your oil. I think it went, what did it go? Minus $20 a barrel, if I recall, for one day. Minus $20 a barrel for one day where you had to pay someone to take a barrel of oil. Anyways, what we're seeing now, obviously, is a return to normalcy. Energy are now at, we're seeing $45 now. We're starting to see some of these stocks kind of creep up from the dead. These value plays that have been out of favor for so long, industrials, banks, REITs, infrastructure, they're finally sprouting life. In this month here, it's been, boom, they've all kind of popped 10, 15, 20%. So especially the REITs, those are the value plays. That is the rotation out of tech and into value, or out of growth and into value. You may have heard that term rotation. If you've never heard it, I'll describe it to you real quick. Rotation means I'm sector rotating. I'm selling some of one sector and I'm rotating that into a different sector. So sector rotation happened recently. We do have a stock pick here from Derek, PKK. All right, that's a penny stock, I believe. Thank you, Derek, for that tip. We'll keep that on our radar and see how it does over the next while. Question here from Johnny Mox. Johnny Mox, one of my producers from the show. Rob, a few of my friends are crypto fans. I tell them to be cautious about investing in coins. Very volatile lately. Any explanation and why? Crypto's come a long way. So those of you that know me and been following me for years know that I was the guy who called the bubble back in 2017. I went on BNN, I pounded the table. I said, we're in a bubble right now and it's going to pop. I was like 3 days before the high kind of thing. And it was at 19,005 and it fell all the way to 4,000. I call that, it was a different era. It was a different time. I was getting phone calls, much like I have a barometer for bubbles, right? I can sense bubbles because of my phone. My phone rings. If 50 people call me today and they all want to buy crypto, I know we're at the top. If 50 people call me today and they all want to sell their stocks, I know we're at the bottom. Right. So I had a bit of a spidey sense there with respect to crypto, and I just knew. Now that was a different era, less transparency in the industry. We've come a long way with respect to the exchanges, how it's now handled. I'm a believer that, and in fact, if you followed this show, we've had some crypto experts. Some of you guys out there should own 1%, maybe 2%. Of your portfolio, of your net worth should be in crypto. I don't know if it's 1 or 2, a small percentage, just as a natural hedge, just as a natural diversifier. And if you weren't sure when to get in, some of you, if you weren't sure when to get in, a good time to get in is always after a correction, right? So we've seen a big crypto correction. So those of you that don't follow crypto's done a huge rally over the last while. Bitcoin almost closed at an all-time high. Tons of volume on the crypto exchanges. Today or this week, they fell 20%, something like that. Too much too soon, right? Just like anything else, too much too soon. So you get appreciation in a currency, in a stock, anything, you get it too fast, too soon. Sometimes you need to take a breather, right? And that's what we're seeing right now. I do think that crypto is, the technology behind crypto, as I learned about it over the last 3 years, I'm going to say, I do think there are reasons where it's going to matter, and there's certainly adopters to it. And I think it makes sense for some of you that have an aggressive profile and that have long-term growth and want a hedge and want a diversification outside of traditional stocks. Some of you might make sense to have a small allocation to crypto in your portfolio. JT's asking me the best crypto to get in now. I mean, again, I can't give recommendations here. Either way, I can't give a recommendation. Either way, I can't give a recommendation. That's a joke, but those of you that read between the lines got it. Can't give recommendations on the show here because I don't know your situation. So Ether, we got to book a call. Go to www.speaktorob.com to book a call. We could chat more about that. Again, I'm not a big believer of investing in crypto, guys. Like, you know what I believe in? Owning companies that generate huge compound growth on their annual profits and their annual cash flows. So those companies that have grown their cash flows the most over the last 5 years, those are the ones that I've wanted to own. And I care less about multiples than I do about owning quality companies. Question here from Guy Bourgeois. Great mustache, Rob. Big fan. Sorry if off topic. Any thoughts on the contactless payments in general e-commerce payment space? Well, I think anyone who's not, and this is absolutely unequivocally a disruptor in the industry. Unequivocally a disruptor in the industry. This is now forming part of some of the largest and fastest growing companies on the planet. I can't give direct advice and direct picks here, but I can tell you that this is a space that tech now is all over. So yes, I'm in. Yes, I think it's changing. I believe the next decade is going to be a disruptor for a lot of things. I believe there's a chance that we see emerging industries and sectors that we never had before. Thank you for the compliment, Lisa. But I will say that when in doubt with respect to portfolios, I think, and maybe I think like this because I'm quote young in our industry, right? Feel free to guess my age, or no, don't guess my age. I'm going to tell you how old I am. I'm not even 40 yet. for those of you that are asking. So I'm a young investment advisor. I'm a young portfolio manager, right? So I bring a different approach to this, but I'll tell you that I would look at the companies that are adopting AI, artificial intelligence, and adopting machine learning. So AI is, they're learning on their AI is artificial intelligence, computers. Machine learning is you give them the data and they figure out what's important, right? So my brother's a big believer in this, and I believe I'm going to get him on the show at one point. Charlie, my brother, he started his own company that does exactly this, and maybe I hang out too much with him, but he's talked a lot to me about this. And I'm a big believer that companies that adopt this, and Guy, to answer your question, all of the contactless payment or general e-commerce payments companies, I shouldn't say all, the leaders in that space, they're adopting machine learning and AI to try to simplify transactions and simplify the contactless payment space. So obviously the big name there is Square. Not going to, chat further on that, but there's a lot of really good companies in that space. Question here about when investing in gold, juniors, big players, or bullion? Okay, so if you're investing in gold, the question is, should I invest in juniors? Should I invest in big players? Or should I invest in bullion? The question I would ask you, Rodney, is why are we investing in gold? Why are you investing in gold? So if you're investing in gold because you want to speculate, right? You want to double your money, you want to gamble, you got that urge, you want to go to the casino and roll a 27 and make 30 times your money. That would be the juniors, right? These stocks are all trading at 30, 40, 50 cents. And as a wise man once told me, a penny stock only needs to go up 1 penny for you to double your money. That's a joke for you, Lisa, if you like that one. But the key with these penny stocks is, you get a bit of good news. They don't trade on anything other than potential future miraculous gold discoveries that probably might never happen or will happen. They trade on how close they are to other claims. And so if you want to speculate, junior gold is a classic case of speculating. And a lot of people have made a lot of money in the last 50 years in Canadian junior gold companies, but many more have gotten wiped out. Many more have gotten wiped out. So if the purpose is speculating, that's where I would go. If the purpose is owning companies and diversifying your portfolio, owning some of the big players, then obviously you want to own some of the large caps. 1 or 2 names, materials, some of the bigger names in the space. The key with those companies is they're going to be more profitable every quarter because they're no longer getting $1,400 or $1,300 per ounce in gold prices. They're now getting $1,700, $1,800, $1,900, $2,000 an ounce, right? So that's I think one of the big things with respect to gold. If you own any of the senior gold producers, is over time their earnings are going to start to look a lot better. Now, if you're a gold bug and you're a believer that you just want to hedge against inflation and you just want to keep an uncorrelated asset to the market under your mattress, basically, then you buy gold bullion and gold bars or maybe a gold bullion ETF. But I'll tell you what, I'm not a fan of that. Period. I don't. I mean, it might make sense for a very small portion of your portfolio. I want to own a gold bar if it pays me a dividend. I want to own a gold bar if it spits out cash every year. I want to own a gold bar if it generates positive cash flow and it has earning growth. So anyways, hopefully that answered your question, Rodney. Great question. I mean, I think generally the answer for most of you is you want to diversify. You want to own a couple large cap Canadian or global gold companies, material companies. Personally, I don't see a huge benefit in owning the bullion. And if you want to gamble and speculate, well, junior mining, you got to hit a 17 and you triple your money. Okay, let's take a look at a question here from Denny Funk. Hey, Rob, can't stand the stash. All right, thank you. Appreciate that. But that's okay. Just curious if you feel that there is a green boom coming on with Biden coming to office. I'm going to ask you this question, Denny or Dennis. Do you mean green as in cannabis, or do you mean green as in energy, like green energy? Because I believe both of those are coming. So I guess you don't need to answer that, but I'll start with the cannabis. So those of you that followed the election, you probably saw there were multiple states that had the cannabis question on the ballot. I don't smoke the green team. I'm not on the green team, but I know that there are a lot of people that like the green team. And I know that there's a ton of appetite for it, not just in Canada and the US. So I think it's coming. There's no way to stop this. There is going to be progression. You can't stop. The dog's out of the barn. So there will be, and not only that, there will be a psychedelic mushroom boom at some point. So I don't know how and when that's coming, but Oregon licensed psychedelic mushrooms, shrooms as they call them, psilocybin, which apparently is really good for PTSD and anxiety if you microdose. So I do think that green boom is coming, and we've seen the stocks react positively because of that. You're telling me that you're asking about energy. So green energy. So I do think that green energy is coming. But the thing with green energy, Dennis, that you have to know and you have to be aware if you're buying and you're investing in these companies, is they have rallied so much over the last months and years that you're really entering, a fairly high multiple here. And a wise man once told me, if you're owning this because you think it's going to be a disruptor, then who cares what you're paying, right? Like I remember a client came up to me, or a friend was like, Rob, I believe that Shopify is going to change the world. This is like 3 years ago. And he was like, I think Shopify is going to be the next, Netflix, Amazon, eBay. And I was like, oh, he said, but I mean, it's at $30 and I wanted to buy it at 28. And I told that person, I said, if you think it's going to be a disruptor long-term, who cares, right? You're not going to care what you paid for it in 5 years or 10 years. Just buy it. So if you believe, Denis or Dennis, I can call you Denise since I know you. I can actually call you Phoenix since I know you. I would tell you that if you think it's going to be a disruptor long-term, who cares what you paid for it? You just want to be a part of that, right? You want to be a part of the sector. A couple different ways you could play that. You could do it through an ETF. You could do it through a renewables energy. You could do it through an infrastructure play. But I mean, if you believe that, now, if you're just doing it as a trade, because I believe your question was, do you think there's going to be a rally because of the Biden election? Then I would say be careful of that trade. If anything, probably want a contrarian trade there. Question from Brent. Would now be a good time to buy in Canadian or US oil? Any preference? Risk to Canadian higher versus US with risk of Senate majority? Very good question. So here's what most people will tell you about oil, and I've been following this closely for a long time, is meh, it's over, give up, pack it in, throw in the towel. These stocks are all going to go bankrupt and there's nothing left there. So I've never been kind of an overweight energy guy. I've always been kind of, let's own a little bit just to have it in our portfolio and make sure we participate. But I'll tell you what, these most recent moves, like the depressed value that we're seeing at some of these companies that are trading at 3 times cash flow, 4 times cash flow. Imagine buying a company that is trading at 3 or 4 times cash flow, like cash flow. I mean, I think if this business person was in my office and was promoting that to me, I would be like, yeah, I'm in, here's a check. But yet there's so much distaste for oil right now, so much distaste for non-green energy, that they're trading at significant discounts. So I'll tell you 2 things. One, if you don't care about the sociological and ecological impacts of you buying oil stocks, take a strong look at the ones that are cash flowing positively. And there might be a couple diamonds in there. Now, they might go bankrupt, just so you know. Like if oil falls, those companies could go bankrupt. Extremely speculative, extremely dangerous. If you're buying the junior ones, the small ones. Now, if you don't care about that and you want to get in, Canadian or US, I feel like the Canadian has been beaten up a lot more. But again, I would diversify, get some of each. If you're deciding that you're going to make a contrarian play, which is to pick up some oil and gas stocks that are down 70%, I would diversify if I were you. And I would not just buy the small caps. I would take a look at the small, the mid, and I'd buy some large. Large cap, yeah. If you're looking at large cap, Brent, if you're looking at large cap, I mean, stick to the good names, and I don't want to say them on here, but stick to the good names and maybe buy an ETF in the US. So a couple good names in Canada, maybe an ETF in the US. That's a contrarian trade, and I'm going to watch this video in a year and see how that did. Okay, what do we got for next question? Okay, I'm looking here. The blockchain technology, what's the impact? Okay, I'm just scrolling through all the comments here. Cryptos. How about this one right here? My kids always ask me this question, and they always ask me, Papa, c'est quoi ta couleur préférée? What's your favorite color? And I'm always like, I don't know. And then I go, I think it's blue, because I have a heck of a lot of blue shirts, and then my wife chimes in and says, that's because I buy you a bunch of blue golf shirts. So I don't know what my favorite color is. Color is, maybe I'm colorblind and I don't care. Any other questions about Brent? Any other questions here about anything that's coming, anything that's, here's a good one. How do you feel about investing in sports cards? Rick from Toronto. Well, I'll tell you what, sports cards have had a boom here over the last while because of COVID. Much like everyone's buying hot tubs and landscaping their backyards and buying PS5s and buying 80-inch TVs and buying Pelotons and Echelons for their basement, the rejuvenation and the discovery of hockey cards has created a bit of a boom here. So hockey cards, much like private art, much like diamonds, much like gold, is a passive asset class where you're basically hoping that someone at a future date is going to pay you more for that asset than what you paid for it. There's no dividend. There's no, there's nothing other in there. So smart viewers might point out to the fact that, Rob, you just said you'd buy a gold bar when it paid a dividend, and now you're going to buy hockey cards. Well, there's a couple things that I like about hockey cards. One, I'm a hockey nut. I played hockey. I coached hockey. I was president of the Carry On Senior Hockey League, of the entire league. I was a GM of a team. I'm now a third liner on a beer league team and at the Dakota Hockey League, where I play for L'Écurie. So I love hockey. So it's kind of neat to own an asset that you care about. But two, I'm a big believer of the fact that they don't make any more of this factor, right? So gold, they're discovering it every single day. There's always going to be basically an infinite supply of gold. I know there's not an infinite supply of gold, but there's a lot of gold. Whereby a 1979, 1980 Wayne Gretzky rookie card from the Topps collection, center cut, 10, pristine condition, mint, rated a 10. There's not many of those, So if you do find one of those, you're getting your 700,000 USD or whatever it is. So I think it's a great diversifier. I wouldn't be pounding a lot of money into this if I were you guys. I wouldn't go out to the sports store and start buying old cards, because this is kind of something for the wealthy or the ultra wealthy, if you will, just like owning Picassos and Rembrandts. But if you like hockey cards, what I would suggest is buy a few older ones that you like and that you want to own. Maybe you're a Habs fan, you buy a Patrick Roy rookie card, or you buy some stuff like that, or some stuff that's signed, and you try to build a little bit of a connection out of it. And that's how you kind of build your collection. And maybe over time it appreciates in value. I personally started playing Magic the Gathering 3-4 years ago. That is not a joke. Anyone who thinks that's a joke, with some of my Magic crew. Shout out to JL and Marty and Pete and Donnie. And we would play kind of Saturday Night Magic. And I discovered MTG, Magic the Gathering. Same thing as hockey cards. They had Alpha Edition back in the 90s and Beta. And I remember looking at those first boxes, and I think it was like 60 grand or something for a sealed box from the first edition. And I remember thinking, that'd be cool if my wife would kill me, but if I spend 60 grand on a Magic the Gathering box. Anyways, I didn't buy it, obviously, but I looked at them recently, and those same boxes are going for several $100,000s. And Johnny Mox is pointing out right now that Pokemon cards are also going for a few bills too, telling me that one sold for 200K. I believe a Black Lotus from the Alpha set, and someone can maybe confirm this for me in the chat here, but I believe a Black Lotus from the Magic the Gathering Alpha set, I want to say it sold for like 300-400 grand, something like that. And I do know that one of my good buddies here in Winnipeg, president and founder of Carmar Collectibles, sorry, is really, really big into this. I'm going to try to get him on the show as well because he knows everything about sports card collectibles. And, I know that he was looking at a Wayne Gretzky rookie from that 79-80 top set very recently. And, he's looking at making a play on that. So a lot of interesting stuff about alternative asset classes, art, Pokemon cards, hockey cards, Magic the Gathering cards, stuff you never thought would fit as part of a diversified portfolio. Questions? Anyone else? You got some more stuff for me, guys? Fire away, fire away. I'm here. I'm ready. I'm going to take a sip while Noel asks me a question. Knowles had a buddy in high school. His name was Noel, born on December 25th. What is NASDAQ? So NASDAQ is the index that tracks the growth securities, mostly tech stocks on the U.S. exchange. So it's been rallying like crazy the last while. It's up 30+% this year in 2020. And there was a time when the entire Dow Jones Industrial Index was down 10, 20, 30%, and NASDAQ was actually positive. So NASDAQ are the tech stocks, the growth stocks, the one that are expected to be disruptors in the future. So some people that have maximum growth profiles, that have a long investment horizon, that believe in the sectors, likely own some stocks that are on the NASDAQ. Donnie Kaler, thank you for pointing out that 250 grand is the highest price played for a Black Lotus. Appreciate that. Any other thoughts or questions here? Hour 9:07 Central Time, 10:07 Eastern. This is fun, guys. This is really, really good. I enjoy this. I enjoy spending time with you guys like this. Tell you guys real quick, those of you that don't know, today's what, Thursday? Yesterday, at the Manitoba Legislature, member of the Legislative Assembly, Asagwara, presented a bill for universal CMV screening. Those of you that know me know that I'm incredibly passionate about CMV research, congenital CMV. It's the #1 cause of infant disability. I've been fighting for about 10 years to try to get a universal CMV screening bill passed so that every child in this country, well, in this province to start, but every child in this province gets screened for CMV. So at birth, they're tested. If they're positive, we treat them. They have better outcomes. Parents are much happier. Kids don't lose their hearing. They don't go blind. They don't die. And as a result, we have a much better healthcare system that's less log-jammed, easier on the education system, less cochlear implants, etc. So that bill was presented yesterday, and I'm pretty excited. If you want to check out the video, go to the CMV Canada page. Check it out. It's a culmination of a lot of work for me and the wonderful people at CMV Canada. Let's take a look at the question here from... thank you, Mox, for congratulations. Let's take a look at the subprime. Do you see the recovery looking the same as a subprime recovery plot? I believe you mean the economic recovery, Brent, and absolutely no, I don't see it at all as the same thing. The 2008 subprime recovery plot was an actual situation where financial institutions went bankrupt, were going bankrupt, and were threatened to go bankrupt because they did not have enough cash on the books. So as you know, there was a huge bank revolution that happened where there were capital requirements for all of these bank institutions, 10, 12%, 14% needed market value recoveries. Sorry. Okay. You're asking me about market value recoveries, Brent. So, well, I actually sent an email to Kevin Vandermeer. He sent me a note about 3 weeks ago or 3 months ago. I put it on my link. I put it on my LinkedIn page. It was 2009 versus 2020. It was the bottom right from the top, right? So what did it look like? The bottom and then the recovery. And it was eerily similar. March 09 to March 2020 was almost stroke for stroke the same recovery. It scared me actually to see it, how similar it was. So I asked him today if he could update that, because I wanted to see how much we've come so far, because the 2009 recovery was big, it was strong. For those of you that remember, the 2008-9 drop was a lot longer because we peaked in 07, kind of staggered through 07, 08, and then September 08, we had Fannie Mae, Lehman Brothers, Bear Stearns. So those companies kind of created a bit of a 30-ish% drop. But coming out of that, the recovery has been very, very, very similar and eerily similar. I do think, 2010 was a good year, but 2011 was a bad year, if you remember, Brent. 2011 was a bad year in the market. We were down. I remember that summer, August, September, we were down, I want to say 25%. And that was not a pleasant time. So I think if your question is, so now we're about, into the next year, are we going to see a 20% recovery, 25%? I'd say no. But I will say this, my spidey senses are tingling a little bit, just so you guys know, probably similar to yours. Obviously, you want to be fully invested. But if you do see any drop of any kind here, a 10%, a 15% drop, you want to be ready to deploy some more of that capital to be investing. Because I do think it's quite possible that we're going to see a 10, 15, 20% correction in the next while here. Not because, there's anything dramatically wrong, just because these things are healthy. These things are healthy for the economy. Sometimes it's too much too soon, right? So if you do see that opportunity, I would definitely be loading up if you have cash on the sidelines. Question here about battery tech, nuclear energy. Wow. Well, battery tech, I believe you must be following this, Dan. You know that is what is actually driving the electric car rally. It's not the actual vehicles. You know this. The reason that all of the Neos and the Teslas and any of the cars, that the car's technology, it's not, it's not that they're making great cars. And I mean, I'm not trying to be disrespectful to Tesla, but the reason that the stocks are rallying is because the battery technology is unbelievable and the infrastructure, right? We're talking about having stations every, half mile, 2 miles, whatever, across the entire planet for people to be pumping their car full of battery juice, right? So that's the future in my mind. It's not the cars, because I'll tell you what, I'm a big Toyota guy. Toyota probably makes a better car, and feel free to disagree with me on that, because everyone that I've ever met that has driven a Tesla says that it's the greatest thing ever. But the reason the stocks are rallying, the reason that people are backing this like ton, is because of the battery and the infrastructure, the battery power and the infrastructure that's coming. So yeah, I am a believer in that future. Nuclear energy, I'm going to stay away from that one. I don't feel I know enough to comment on it today, Dan, so I'll just stay away from that one. Question here from Brent. Brent is loading up on questions today. Thank you, Brent, for questions. What percentage cash reserves would be a good amount to have on hand? I was luckily invested fully when the vaccine news was announced, but with the significant run-up following the vaccine news, combined with all the negative news and rising case counts lately, I'm hesitant to stay fully invested at all times. Now, if this is non-registered assets, Brent, we could talk about leveraging. But if this is just your straight up RSP and your TFSA, I would tell you that being fully invested the vast majority of the time is not a bad thing. Okay, you want to be fully invested. The opportunity cost of not being fully invested is too much. I can't tell you how many times I've met people that have come to me with their statements, showed me their statements, and I go, what the heck, you're all cash? What happened? Yeah, I went to cash back in the crash. I'm like, what crash? Sometimes it's 08, sometimes it's 2011, sometimes it's 2015, sometimes it's 2018, sometimes it's 2020, but they went all cash in that account, and they've just been sitting there. Do you know how much the multiple has been since 2008? If you went all cash, how much you've missed out? The opportunity cost, the amount it costs you to miss out on a rally is so significant that you cannot afford to be fully out of the market. Now, I do believe in tactical asset allocation. So tactical asset allocation for a guy like me would mean selling an asset class. And we did this trade. We did this trade in March. Selling an asset class like a private real estate investment trust or maybe a fixed income asset. So you sell that and you invest in equities, right? Or you sell equities. In January, I went on BNN. Those of you that followed me, mustache free, a lot fatter than I am now. I went on BNN and I said, I believe the markets are overvalued right now. They shot a plane down in Iran. The market was up 200 points. Doesn't make sense to me. We're trimming a little bit of equities. So we trimmed 10% equities, for our clients. Now, did we go cash? No, we do asset allocation. So we went to either fixed income or alternative. We still want to get a yield from that. So Brent, if you're a max aggressive investor and all you're thinking about is, compounding at the highest possible level, I would tell you that, just be careful going out of the market because of the market timing risk. I would never want to do more than 10 or 15% if I were you, just because what if you're wrong? You don't want to be wrong on this. And we do believe there's a 4-year cyclical bull market coming up. So the gain that you would potentially gain from being out is the amount of the drop. And don't forget, you would have to be exactly right on the drop. You'd have to call it perfect. And as my dad says, catching a falling knife is not the easiest thing on earth, right? So let's say we do get a crash, we do get a correction, then what? Are you going to invest everything at 10%, at 15%, at 20%? So I would just caution you to just be careful with going to cash. Instead, what I would do if I were you, I would look at going to alternatives, private debt, private real estate, private equity, something that's uncorrelated to the market that you can buy, you can sit on, is going to be flat, is going to produce income for you, tax efficient. And then if ever the market crashes, you could sell that, liquidate it, buy your stocks that have dropped down. Question here about the vaccine. Okay, it's from Sean. How will the introduction of a vaccine impact the economy? Pause. The economy or the markets? Those are two different questions, but I believe you're asking about the economy, since that's what you wrote. I mean, I think we all kind of have an expectation that the vaccine will allow us to do some sort of level of reopening. Now, I'm not an epidemiologist or a virologist or an infectious disease specialist, although I do spend a lot of my time on the charity work that I do with infectious disease experts. So I don't know exactly what will happen. I do know that vaccine hesitancy is a serious problem in our country. And vaccine hesitancy, in my mind, is going to be the biggest concern going into 2021, is the sheer volume of people that are going to choose to not to take this virus. Because as a reminder, I don't want to get political here, but for a vaccine to work, a virus needs to not be able to find another host. If a virus can find another host, it can survive. Once the virus cannot find a host, it can't survive. If 60%, we typically need 60% herd immunity in order for the vaccine to slowly die off. If our vaccine is effective to the tune of 85 or 90%, which is what they're saying with respect to the AstraZeneca virus, the Pfizer virus, and the vaccine, Pfizer vaccine, Moderna vaccine, and the AstraZeneca vaccine, you can have a few people not take the vaccine and it's still going to work. But if you have 10 or 15 or 20% of the population not take the vaccine, now you're below that herd immunity and the virus will just survive forever. So I think the biggest problem in 2021 is going to be vaccine hesitancy. Anti-vaxxers are dangerous when it comes to stuff like this. That's my view, respectfully. So how is the vaccine going to impact the economy? The quicker we can get it, it's got to be safe, obviously, and I'm not commenting on that. But obviously, the quicker we can open up, the quicker we can go to Vegas and you can go out for dinner with your wife, Sean, and I can take my kids to their dance lessons, and we can go for lunch here at the office. It cannot be understated how significant this impact is. Now, if you're asking me for the impact on the market, I would tell you that the vaccine impact is already priced into the market. The market is expecting life to get back to normal at some point, which is why we're hitting all-time highs when we're having all-time deaths, all-time high, COVID cases and all-time high deaths, right? It doesn't, there's a disconnect there, right? Anyone who's watching is like, I don't get it, Rob. I'm not an economist, but like people are dying at an alarming rate. A lot of people are unemployed. We can't spend because the restaurants are closed and gyms are closed and theaters are closed. Malls are closed. How are the markets at all-time highs? Someone might be asking that right now, to which I would tell you the market is seeing 6 months, 12 months down the line when we got our vaccine, grandma and grandpa are coming over to visit, and, we're walking up and down malls like we used to, and life's back to normal. Now, if that doesn't happen, watch out, because this market is not going to appreciate a delay in the reopening, is what I would say. Question about travel stock. Jasnikowski. Andy, good to see you. He's asking about travel stocks and Carnival Cruise Lines, Air Canada. Andy, I was watching yesterday my video from March 23rd, the first episode of the Tatro show. And in that show, I said, listen, I know it's hard. Your heart hurts right now. You don't want to invest. You feel like it's impossible for you to put money in the market right now because the Dow has fallen 40% and you think it's irrational to be buying companies. Put the money in the market is what I said. Put at least half your money in the market today. And if you want to gamble, is what I said. If you want to gamble, load up on travel companies, because I think we're going to get back to normal. This is what I said in March. On March 23rd, this is what I said on our show. And as it turns out, those stocks have now doubled or tripled, but they're still nowhere near where they were prior to COVID. So I'll tell you what, Andy, not all travel stocks and hotels and airlines are created the same. You look at casinos, for example, that have a stable influx of other revenue, right? Those are more defensive, right? They're not going to rally as much, but they're more defensive. And then you look at airlines, and then you look at cruise companies. Well, cruise lines, like, that is probably the riskiest play you can make. But if you're a believer that life will get back to normal and we're going to get back into this petri dish of disease and infestation, which is a cruise line, which is how, COVID, a lot of cases spread like crazy, and you believe that life will get back to normal, they're trading at ridiculous discounts. Question is, are they going to survive? So I'm not going to tell you what to do, Andy. I don't know your risk tolerance. I don't know what you want to own, but one of two things will happen with those companies. They're either going to be overextended. They're not going to be able to pay their debt, and they're actually going to go bankrupt and file for Chapter 13 in the US, and they're not going to be able to service their debt. Okay. Or they're going to do another debt issue. They're going to string it along as long as they possibly can, raise capital, borrow from the government, try to get a bailout. And then at some point they get some revenue, they're able to be profitable, and then life gets back to normal. And then you get that same stock. The other possibility is a hybrid of something in between, right? Where they get, they're not quite able to get back to profitable because nobody wants to go back on a cruise, which obviously would mean bad news for a stock, because the margins on these cruise lines, they need full boats, right? They need full boats in order for them to be profitable. So I'm sorry if I didn't answer your question, Andy, but I'd say depending on your risk tolerance, there's a whole bunch of opportunities you can take there. And happy to book a consultation if you want, Andy. www.speaktorob.com. Oh, and he gave me a compliment, so I'm going to put up the compliment right now. Love the November stash. Where are we at here? Did I miss a question here from Donnie Kaler about the CMV fundraiser? The CMV fundraiser is going to be held in June. Le Classique is going to be held in June, I believe the 17th or something like that, that weekend. Western Canada's largest outdoor winter 3-on-3 ball hockey tournament, which I founded and organized with Marc Fouadard. We're doing that in June. So it's not going to be winter's largest 3-on-3 ball hockey tournament, but it's going to be a good time for sure. Thank you for the comment, Donnie. Where else we at here? Questions. Did I miss any questions, Diego? Feel free to post them if I did. If not, wow, I've been crushing it here for 90 minutes. So I'm going to maybe just take a breather here. And thank you all for tuning in. I'm going to ask you guys this. If you're watching right now, please take a sec to subscribe. If you haven't subscribed by now, I don't know what to tell you. I mean, I could do a dance. I don't know. Thank you for tuning in, guys. I'm gonna shut her down there. I'm thankful that all of you took the time to be here today. Rob Tatro from robtatro.com, portfolio manager, Canaccord Genuity Wealth Management, raising money for prostate cancer and for the Canadian CMV Foundation. Thursday night, Portage in Maine, Winnipeg, Manitoba, snow outside. Great to be here. Thank you all for tuning in. I will wish you a great weekend. Stay positive and please keep testing negative. All right. Have a great day, guys.